Welcome to the Explainer. We are jumping right into the numbers today for an absolute grocery aisle staple, General Mills. We've got a major mystery on our hands, folks. Is this heavily beaten down stock a dangerous value trap, or is it an incredible hidden gem just waiting to be scooped up? Let's find out. We have a lot of ground to cover, so here's our roadmap. We'll look at the big price drop, explore the deeply discounted valuation, check out the red flags with shrinking growth, tackle the dividend dilemma, and finally, wrap it up with the final financial verdict. Kicking things off with part one, the big price drop. So General Mills stock has taken a massive hit. We're talking an eye-watering 39.28% drop from its 52-week high, bringing the current price all the way down to just $33.61. To put that into perspective, the year-to-date return sits at a negative 25.46%. For a company historically known for its rock-solid stability, a nearly 40% haircut from its peak, that is a shocking development that immediately demands our attention. But here's the bait. What's really fascinating is how that massive price drop triggers a huge surge in yield. Because the stock plummeted, the dividend yield has been pushed up to a tantalizing 7.26%. And this instantly sets up our classic bulls versus bears investigation. We've got immense capital destruction on one side and this mouth-watering yield on the other. Moving right along to part two, a deeply discounted valuation. Now, before we look at the exact numbers, let's quickly touch on the margin of safety. This is absolutely crucial. It basically tells us how much of a discount we're actually getting compared to the stock's intrinsic or true worth. Think of it like your financial shock absorber. The larger the margin of safety, the more room you have to breathe if the company hits some unexpected headwinds. When you stack the current price of $33.61 up against a calculated fair value of $62.71, the math is honestly staggering. You're looking at an estimated 46.40% margin of safety. That is a massive, incredibly rare discount for an established consumer defensive company. The market is literally pricing this business at nearly half of its fundamental worth. And the bull case builds even further when we check out the earnings. The current price-to-earnings ratio sits at a rock-bottom 8.22, and the forward PE is just 10.44. Just to frame that up for you, that 8.22 PE is nearly 40% below the company's own 5-year average. So, by almost every traditional valuation metric out there, General Mills is sitting straight in the bargain bin. But wait, let's look at part three, red flags and shrinking growth. Okay, the red flags here are undeniable. We are looking at a fast accelerating downward trend. If you look at the 5-year column, things are, slightly negative, but as we move to the 3-year and then look at the 1-year trailing 12 months, the bleeding really worsens. Revenue, down 6.50% over the last year. Net income, down over 13%. And most alarmingly, earnings per share has plummeted by 50% in the last year alone. The shrinking isn't just happening, it's speeding up. Compounding those ugly growth metrics is the balance sheet. General Mills currently has a moderately high debt-to-equity ratio of 1.49. And to make matters worse, this ratio has been creeping up, sitting almost 11% higher than its 5-year average. So to recap, we've got falling revenue, plummeting earnings, and rising debt. Not exactly a winning combo. Which brings us to part 4, the dividend dilemma. This right here is the exact risk keeping investors up at night. A staggering 78.92% of the company's trailing 12-month free cash flow is being eaten up just to pay that massive dividend. That leaves barely 21% of free cash flow to pay down that creeping debt we just talked about, or to reinvest in a shrinking business. It is an extremely tight margin for error. Yet, on the flip side, history does give the bulls a glimmer of hope. General Mills has actually managed to increase the dividend for 6 consecutive years. Plus, historically, their 5-year average free cash flow payout was a much safer, much more comfortable 55%. If management can right the ship and return to that historical norm, investors buying in today could see a 10-year forward yield on cost of a phenomenal 10.38%. All right, let's wrap this up with part 5, the final financial verdict. We are left with a really fascinating contrast here. In the bull corner, we have a stock screaming deep value, boasting a 46% margin of safety, a nearly unheard of 7.26% yield for this sector, and a rock-bottom PE. But in the bear corner, pitted right against it, is undeniably shrinking business growth and dangerously tight cash flow. EPS is down 50%, and almost 80% of free cash flow is going straight out the door to fund the dividend. So what does this all mean? based on all the data we've unpacked in this explainer, the final verdict is really up to you. Does that massive margin of safety give the company enough of a cushion to turn its declining revenues around? Or is the accelerating loss of earnings, combined with that high debt, a glaring sign that this business is fundamentally broken? I'll leave you with this to ponder. Is General Mills a brilliant value play or a dangerous value trap?